Today, we're taking a deep dive into the fundamental business transformation of Jinhua New Materials. We're going to deconstruct the strategy behind its major pivot and, just as importantly, quantify the market's dramatic reevaluation of the company that followed.
So, here's how we'll break this down. We'll start with the core thesis, then we'll quantify the market's reaction. After that, we'll analyze the traditional business that's funding all this, look at the robotics catalyst itself, and finally, wrap up with a clear-eyed view of the financial realities and risks involved. All right, let's get straight to the point. The central idea is this. The investment story for Jinhua New Materials has fundamentally changed. The company is moving far beyond its traditional industrial identity.
What we're seeing is a complete redefinition of the company's identity. And let's be clear, this isn't just about a minor new product. This is a strategic leap into the market for electronic skin, a technology that's absolutely critical for the next generation of robotics.
And how did the market react? Well, the response was swift and it was significant. In just the 6-week period after September 1st, 2025, the stock shot up 32.0%. That signals a really rapid and material reevaluation by investors.
Okay, so now let's dig into the data behind that number. We're going to look at both its performance relative to the market and the trading activity to really quantify the alpha that was generated here.
The data here tells a very clear story. You see a stark difference. The company's 32.0% return completely dwarfs the CSI 300 index, which was only up 2.1% in the same time frame. This is a strong indicator that the stock's movement was driven by company-specific news, not just a rising market tide.
And what's interesting is that the technicals really back up this story. This wasn't some low-volume speculative blip. The rally saw multiple days of price jumps on heavy trading volume. That's a classic pattern you see with institutional capital moving in and accumulating a position.
But to really assess if this big strategic move is viable, we first have to understand the company's core business. This is the financial engine, the cash cow, that's supposed to power these ambitions.
Now, if you look at the cash flow statement, a very clear strategic pattern emerges. Historically, you have this positive cash flow from operations being systematically plowed into massive investments. And more recently, you see they're bringing in significant cash from financing to really step on the gas.
So what this is telling us is that the company is in a full-blown, high-intensity investment phase. They're using both their own earnings and outside capital for some very aggressive CapEx. But, and this is a critical point, that sharp drop in operating cash in the first half of 2025 is a major warning flag, signaling some serious short-term pressure.
And this breakdown really gets to the heart of why this pivot is so strategically important. For years, the company's return on equity has been held back by low net profit margins. That's just the nature of their legacy materials business. This move into robotics is a direct attempt to solve that problem by entering a much higher value market.
Which brings us to the core catalyst driving this whole reevaluation, the company's strategic jump into the high-growth world of robotics.
So what exactly is electronic skin? Think of it as a critical piece of technology that gives advanced humanoid robots a sense of touch. It allows a machine to feel its way around, which is absolutely essential for doing complex tasks and, frankly, for interacting safely with humans.
Now, this isn't some random shot in the dark. This pivot is built on a really powerful synergy with what the company already does best. Jinhua has decades of expertise in making advanced films and in precision coating. That gives them a unique manufacturing edge when it comes to producing the complex, flexible material that electronic skin needs.
And the potential scale of this opportunity is just immense. Projections are forecasting that the addressable market for electronic skin in China alone could hit 905 billion yuan by 2030.
Okay, but no analysis is complete without a hard look at the other side of the coin. We have to address the financial pressures and the key risks that come with such an ambitious corporate makeover. Because let's be clear, while the strategic thinking is compelling, the actual path forward is facing some pretty significant headwinds that have to be monitored closely. This whole move has really split the market into two distinct camps. You had the bull case, which sees this as a logical, smart transformation that leverages the company's core strengths. Then you had the bear case, which views it as a highly speculative pivot, arguing the valuation has become disconnected from reality and pointing to those weak H1 financials as Exhibit A. So the key risks really fall into four main buckets. First, there's valuation risk. A price-to-earnings ratio of around 113 is very high. Second, financial risk from that combination of weak cash flow and heavy spending. Third, plain and simple execution risk. Can they actually pull this off? And finally, you have emerging competition as other players are starting to crowd into the space.
Ultimately, the entire story hinges on this one question. The company is taking its established industrial foundation and placing a high-stakes bet on a frontier technology. Whether that synergy becomes a defining competitive advantage or a very costly misstep is what will determine the next chapter of this company's story.